Hello everyone, I am Shri Pillai from Gajera School. Here in this session, we will talk about the monetary policy of RBI to control inflation. So, we have already discussed about what is inflation and types of inflation. Here we will understand about the monetary policy of RBI to control the inflation. Right? First, you need to understand what is the reason for price rise. What is the reason for inflation? Right? One of the reason is demand. Right? We have studied about this. One of the reason is demand. First, you have to understand that what is the reason for demand. The reason for demand is money supply. Higher the money supply, higher the purchasing power of the people, higher the demand and more inflation. Right? So, to control the inflation which is caused due to the demand, what are needed to do? What we need to do? Right? Reduce the purchasing power. Right? Reduce the purchasing power of the people. And how can we reduce the purchasing power? How can we reduce the purchasing power of the people, or how can we reduce the money supply? So here solution is what? Reduce the money supply. Right? How can we reduce the demand? By reducing the money supply in the market. Right? This is the objective of the RBI. Now, how to reduce the money supply? For that, you use the monetary policy. RBI uses the monetary policy by making the money more expensive. They make money more expensive. How they can make money more expensive? By increasing the interest. Right? By increasing the interest on the loan, credits, right, and increasing CRR. Now, what is CRR? CRR in the sense cash reserve ratio. CRR is an amount of funds that bank has to maintain with the RBI of India at all time. Right? All the commercial bank have to maintain some amount, some fund with the Reserve Bank of India. That is known as CRR, cash reserve ratio. Suppose with the example we will understand this. Suppose it is 4% now. CRR in the sense they have to deposit 4% of money in the Reserve Bank, right? It 4% now. Rate of deposit is 4%. Now it is increased to 5%. Then what will happen? The bank have to keep money with the RBI. 5% it is rate of interest is increased, so bank have to keep more money with RBI, so bank have less money to lend, right? So bank has less money to lend. The credit creation capacity of bank will be affected, so money supply will be affected, so the purchasing power of the people will be affected, right? That will come down, so the inflation will come down. So that is how the CRR works, right? Reserve Bank of India has control over the money supply in economy, and they increases the rate of CRR, right? So that credit creation of the bank will be affected, that will be reduced. If they don't have that much money, how can they lend, right? So the credit creation capacity of the bank, commercial bank, will reduce, right? In this way CRR works. Now let's understand instruments of monetary supply. Rate of interest. RBI increases, RBI control the lending power of commercial bank. They will control the lending power of commercial bank. What the first step the RBI has done? Increases the CRR, right? So they have to deposit more money, they have to reserve more money in Reserve Bank, more fund in Reserve Bank. Now they have less money to lend, right? And now what the RBI orders? To increase the bank rate, bank interest. Lending power of the commercial bank is controlled by RBI. So RBI orders to increase the bank rate, the rate at which the RBI lend money to commercial bank, right? The commercial bank will increase their lending rate. Lending rate increase in the sense what? Increases the interest on loan or credit, right? The loan or credit become expensive, which stop the unnecessary capital investment. On the other hand, the saving tendency of the people increases. Now what happened? The commercial bank will offer high rate on the deposit and investment. That's why what will happen? The saving tendency of the people will increase. Money supply in the hand of the people reduces. How? Because interest rate is high, so they will not purchase or take the loan, and even they will get more interest in savings, right? Deposits, savings, so that they will start saving the money, right? So the saving tendency of the people will increase. Due to increase the rate of interest on deposits, so money can come back to the economy in the form of savings, right? As there is decrease in supply of money in the hand of the people, what will happen? The spending will reduce, right? The spending will reduce, and automatically the price will reduce. The price rise will not take place. Price rise will be under control, right? Now open market operation. Reducing money supply through selling the government securities in the open market, right? It is done by the agency function of RBI. RBI sells what? They start selling the government securities in open market. So the people, the commercial bank and the public will invest in these securities, and so that once again the money from the market will come back to the bank, right? So it will decrease what? Decreases the supply of money in the hand of people. Now what happened? The people have low money, right? Low money supply in the market, low purchasing power, low demand, and price will under control. Understood? This is the monetary policy. This is the monetary policy can be used. This monetary policy can be used when the inflation is caused due to demand and money supply, right? This monetary policy can be used when the inflation is caused due to demand or money supply. Okay, only this much for today's session. Thank you.